Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session to late session market update for Tuesday, August 20th, 2019. It is 2:30 p.m. as I'm starting this video. I wanted to do it at this point so I can get it out plenty of time to watch it before the close. Really not that I expect anything major to happen today. I just wanted to get my thoughts out there. I posted a few charts, talk about the trading environment, what this recent trading range means to swing trading, and then share a few other things I haven't covered, as well as an update on, I want to update semiconductors, the SOXX trade, which hit the stop yesterday. I want to do an update, share my thoughts on the semis, and hit on gold and treasuries as well. So that's what we're going to look at. The stock market, treasury bonds, gold, semiconductors, and one other thing I want to show you here. Let me just start out with this. We're on this daily chart of SPY, so I'll start there. To keep it very simple, maybe at the risk of oversimplifying things, this is the important range I'm watching right now. This was my, going back to the lows here, that was August 5th, so that was the day before. I can't remember if that was a Monday. Here, I can tell you here. Let's see, that was Monday, August 5th. So that was Friday the 2nd. So since August 2nd, the market has traded pretty clearly in a range here between that 294, which again was my uppermost bounce target in the bounce target zone from back here when we hit the bottom. And it's hit that level several times, and we also have several taps down below. So this is pretty significant. Now, what it is, obviously, it's a trading range, very, like I said, well defined, pretty technically significant, because when you have the longer a security coils in a trading range, the more tags you have on a support or resistance level. This is sort of, I view this as like a coiled spring. You're building energy, and therefore the breakout, an upside breakout, could be potentially, be bullish on face value if it breaks out. I'm going to give you my thoughts there. That's the bullish scenario, but I'm going to put an asterisk by that. And I'll explain that in a minute. Whereas a downside break, which is still what I favor, but my convictions right now are not as strong as they were back here. So let me start out with this chart. So again, those are the ranges, and until then, recognize it for what it is. I didn't think we'd be in a trading range this long. I thought a couple weeks ago, my preferred scenario, and I felt pretty good about it, didn't pan out, was that we'd have a leg down, a kickback rally, went right up to the, almost to the penny to my max bounce targets, and then the next leg down. That is a normal correction, even a minor, what we call an ABC corrective wave within a larger trend. Even if the market's going to new highs, that's usually what fits. You saw one here, A, B, C. That's typical. Sometimes this was a small blip, more of a pullback. This was a larger correction, more on line with this one. And and I've covered this before. Even that top off the October or late September, early October highs back in 2018, you get that initial kickback rally and then another leg up. Then we kind of went here. We got into a sideways trading range, and it was pretty big. And there's an example. You came up 1, 2, 3 tests to the top, several tests on the bottom. Finally, when it broke, that's what I'm talking about. There's your coiled spring, big old spring. Big old drop. That doesn't look like, it does look like a lot. If you were trading, it was a lot. That's another 11, over 11% drop, and that's just the S&P, not even QQQ. So those are the ranges, and again, at the risk of oversimplifying it, let me pull up QQQ. Okay, the ranges on QQQ is about, rounding off these numbers, 189 down to about 179 or so. QQQ made a little bit higher lows each time, but still, that's the recent, and that's a 200-day. So again, bullish for an upside break, a definitive, impulsive, not just pop your head above intraday like we did back here and then close back below. That's, you got to really close above there or down below. So I'm still favoring this one, but again, because of the nature of this is not, we didn't get that correction and then the next leg down. Something else could be going on here, and I also want to address some things going on with treasuries and gold. So that's it. And now, what does this mean to swing trades? Why haven't I put any more swing trades? Well, the SOXX trade, which we got stopped out once, re-entered, stopped out again. I had a question come into me yesterday. A member had replied to the member subscriber email post notifications when a new post is made, and asked, "Hey Randy, should I stop out of the SOX trade because it went under the suggested stop. I'm going to get to that trade in a minute, and I'll share my thoughts there and on that, and what to look for going forward on that one if you're still in it or if you plan to re-enter. All right, so let's just stay on the broad markets here, and again, so for simplistic sake, that's what we need to do now. The reason I put an asterisk above on an upside break here, it would be that we have quite a bit of resistance overhead. First of all, this area here is the recent breakout to new all-time highs in QQQ. Remember, everything, all the major indexes, sectors, QQQ, SPY, even XLK, as I covered yesterday, which I'll try to hit on here, they had broken out to new highs, and they traded above there for a little while. We're looking at it on a 60-minute chart here. And as I suspected and predicted at the time, that they would probably fail. It's usually breakouts that occur for all the reasons I cited, breakouts that occur while the markets or security is overbought with negative divergences, everything else have a much higher rate of failing. I should have just highlighted the divergence. So that was a divergent high, and again, it was made clear on the daily chart as well. We had the divergent high, we broke out, so that's that failed breakout range when I look at it here on the daily chart. So as I often say, resistance, which was the previous highs on QQQ, once broken becomes support. And so the breakout held for a little while, and then it failed. And at that point, it didn't just fail and dip down below and then go on. It failed and failed impulsively. So that is, this whole thing right here made it clearly what we call a bull trap or a false breakout, fake out, whatever you want to call it. And therefore, that former resistance, then support, now once again becomes resistance. So that's point number one, and that's why I think if this pops to the upside, could be a runaway market. Very well could be, and you need to prepare for that and act accordingly if whether you're short or you want to go long and trade it. But again, if we pop it, there's quite a bit. There's a resistance zone, these two lines plus a downtrend line off the highs on QQQ. So I mentioned this morning in a post on the front page, I believe it was, that I have to imagine, this is just technical analysis 101, there's a lot of reactions here. If you trade and use technical analysis, if you don't see this as a significant level, then you need to get back to the books and study, and that's fine. That's what this is all about. That's why I share. But that is a well-watched level. Why? Because we've had so many reactions there, and the volatility has spiked. We're having big swings into it, and it's stopping the market cold. Okay, Randy, what does that mean? Well, what it means is it is a very technical or technically significant level, and TA 101, Technical Analysis 101, says, if you're a bull, you look to go long on a breakout above that level, and if you're a bear, you look to short bounces back into that level. They're all objective because it's resistance is resistance until and unless taken out, and then likewise, it would say a logical place if you've been shorting that level or shorted it once, 3 times, adding to your positions, a logical stop would be somewhat above there, allow for these intraday spikes. And so that's a logical cluster where you can imagine a lot of stops on shorts are placed right now. And so the market, if the powers that be, whatever forces drive it up there, maybe it's the algos, the big trading desks at, the big firms, Goldman and all that have enough money to actually move the market. And, they have enough buying power to fire off, if they time everything right, get it just right, bring the market up, pop the stops. They go long before they do it. They profit by popping the stops being popped in itself. When you have a short trade and you have a stop, it's a buy to cover stop loss order. So that means you will buy the stock. That buying begets, creates more buying. It's a vicious cycle. So then you go up, and that would be it's my secondary scenario, and it's my more bullish of the two, but it's still not very bullish. It would just be that stop pop probably would fail, clear out those stops, hit the trend line or the bottom of that zone, turn around and go down. I'm still leaning towards not as strong, but still leaning towards my primary scenario. I'm still positioned as such that we will fail once again, because as I like to say, resistance is resistance until unless taken out. So if we fail here yet again today, remember we traded there all day yesterday. These are 60-minute candles. I'm zooming in right now. We gapped up to it and spent an entire day. We haven't seen price compression like this in a long time. That's one full day of trading right there, in within a range of, here I'll tell you, if I grab the highest point of the candle, go to the lowest point, 0.70%. Okay, that's, back here we had high to low 1%. Here was probably 2% or more, and here was obviously a lot more. So this was high volatility. Volatility is compressing, and it's showing the sellers aren't stepping in. The short sellers or longs aren't selling, but the buyers aren't stepping in enough to take it out. This is a battleground right now for about the 189 level on QQQ. That's the post I made this morning. And so again, a pop above it, certainly on face value is bullish, and you have to respect it. Maybe we go on through there. Maybe we just keep on going and we go to new highs. Like I said, if we go much above those resistance levels, there's not a lot of resistance then. You've taken out that key resistance there that was the resistance before for the breakout, and you've taken out the downtrend line. So again, that's to try to quantify it for you, and that's why I'll give it a little room. I'm not going to be shorting into it anymore. I have my fill of swing shorts. I'll sit tight with them. That's only about 1% above that level there, so it's not very high. Anything much above that just does not help the bearish case. Let's just say that. SPY, same story. I had the 294-ish bounce target, and again, it's easier. I showed you the daily chart already. That's those are the levels to watch there on SPY. One other thing I wanted to show you on the stock market is, and talk about this. Based on everything that I've been highlighting, right now we're only looking at the 60-minute and daily charts. I could go out to the weekly. I could even go out to the monthly charts and tell you there's a lot there that indicates a pretty good likelihood of a major drop coming in the market. We need that catalyst. We need to break these lows, those divergences, everything I talked about on the breadth indicator video, as well as the divergences in price between the momentum indicators, such as the daily chart or the weekly and daily and monthly charts. Those can continue to diverge for a while. And then the thing is too, although they play out much more often than not, well over 90% of the time, those negative divergences result in a trend reversal, meaning a correction, and a positive or bullish divergences, from my experience, 90% or more of the time, when they're confirmed and they're clean divergences. Those are terms I use. I won't get into that now. I've covered it many times, what I differentiate between potential divergence and confirmed. But again, confirmed divergence, very high chance you're going to have that trend correction or reversal. The problem is it can take a long time to play out. And then the other problem is there are no guarantees. So every now and then it won't play out. Divergences get burned through, and the security keeps on going. So that's where, of course, stops are for. If you're wrong, you stop out and live to trade another day, move on to the next one. But here's what I wanted to show you. I have let me see if I can find. Okay, I found this chart in an article I came across recently, and the chart's from RBC Capital Markets. And what we're looking at here may be a little blurry. I had to screenshot it and expand it. This chart shows you the asset manager. So these are professional, money managers. Net long positions for U.S. equity futures. So these are stock index futures like ES, the S&P 500, NQ, or even the big contract on ES. These are futures. And now you might say, oh, well, that's good, Randy. Those are the pros. They're bullish. No, not good. And the thing and this is how the markets work. This is how technical analysis works. This is how the markets work. If everybody's bullish, and most importantly, bullish in positioning, not rhetoric. What I mean by that, just digress for a second. I like to look at sentiment surveys, and I find them useful at extremes. I also find there's often a lag time there. I'm talking about like the AAII, a survey that measures the number of market participants that are bullish versus bearish. But I always say that's in rhetoric. That doesn't necessarily mean their money is where their mouth is. If I agree to participate in that survey, I might check a box that I think the market's going up over the next 6 months, but I don't necessarily have to be in the market. I may or may not have a position. I may or may not be fully invested. So when you look at this is, people's money where their mouth is. This is the actual net long positioning. So you can see, as it says here, Back in January of 2018, if you remember, we had the market was in an extended period of very low volatility, a strong rising, steadily rising market, and then boom, we had a mini blow off top and one of the biggest corrections in years in late January that went into the February lows. That was this. Before that point, we had not this line, these net long positions on futures had not been anywhere even close to that level until just before the market top in 2007. Remember, the stock market topped in October of 2007, right around this point in time. So, and the way this works is, if everybody's bullish, let's say hypothetically, when the very last bull has bought his or her last share of Apple or Intel or SPY or QQQ, they have no more money to buy. They're all in. Their portfolio is fully invested. So that's sort of how this works. When everybody's bullish, there's no one left to buy. And more importantly, you have a lopsided, one-sided trade where all of a sudden, when the tide shifts and things start to go the other way, you have a lot of stop-loss orders, you have a lot of margin calls that get hit, and it's a vicious cycle. So again, what you had back in 2007, and I'm expanding a little more on what the article said, just looking at this chart, you had what I call a shot across the bow, and you had a pretty good correction back in '06 before the market topped. And about a year later, or a little later than that, you had the top come right around there at those extreme levels. We hit that in January, big correction, long positioning dropped down, stops were hit, people got out, and then finally the market went up, made new highs, they did it again. So that's the point here. And then once again, this says just recently we're right back to those 2018 highs as of mid-July 2019, and it just abated a little bit in July. But this, and based on this, by the way, remember, this was the September right here. That was the top in the market before that biggest drop. We had a 20+% drop in the fourth quarter right after this extreme reading, and that was the biggest drop in the entire bull market, or technically, again, if you want to call it a bear market, call it what you want. So this, to me, where I'm going with this is more of a, I don't want to be dramatic. I don't try to post dramatic analysis, but I'll say this is more of a crash indicator or a big drop indicator, if you don't want to use the word crash. When I say crash, I'm talking just a big, very sharp sell-off. We're not going to see 1987 again. If you're new to investing or trading, Black Monday, 1987, where the market dropped 23%, I think, in one day, can't happen again because of circuit breakers and all that. So don't worry about a 23% gap down against your position. They'll halt trading, and the market's not going to. They could continue to open it, gaps down more, stair step down there. It's just not going to happen at once. But a crash is just a very strong and powerful sell-off. Let's just call it. So am I warning of that? No, but I'm warning the possibility. In other words, crashes usually don't come they don't come when the long exposure is low, when short interest is high, when there's a lot of bearishness. It's from extreme bullish sentiment. Now, remember, we backed off a little bit, but just recently the markets were at new highs. So I wanted to point that out and just tell you that, and it kind of dovetails into the analysis I'm showing you on QQQ and SPY. We're in that trading range. We're in that coiled spring. Don't fall asleep at the wheel. This coiled spring is not the usual low volatility. Remember, just before the highs, going back just a few weeks ago, I said, look, guys, volatility has compressed down to nothing. But from this comes the big moves. Don't fall asleep at the wheel. Sure enough, we had a big drop 3 weeks ago in the market. One of the sharpest drops. It was the sharpest drop, I believe, all year in a period of a week or so. All right, so that's that. And where I'm trying to go with this is, this tells me that as big as that drop was, let me go back to SPY right here. Let's turn off the lines. This drop right here, like I said, the sharpest over such a short time period all year. 4 days we dropped, what is that, about 6, almost 7% in just SPY, more than that in QQQ. That to me is, as sharp as it was not enough to satisfy that extreme positioning in the futures. Hey, possible, but all I'm trying to say is the risk is there. So therefore, if we do suddenly break down to the downside of those trading ranges I showed you before, it could open up something like this. Because remember, I just used earlier the analogy of this right here after the initial leg down, and we went into this consolidation period. This, although it appears smaller, it could be the same net effect. Just spark the next wave of selling, whether it's smaller or possibly bigger than that. I don't know. And again, maybe we break to the upside, and then it's not such a problem anymore because we're out of that. That we break to the upside, and if we continue on up, maybe those extreme long positionings are not unwound. Well, they wouldn't have any reason to be unwound. See, it's all kind of conditional on that. We go down, break to the downside soon, and what's going to happen is all those longs are going to have their stops hit, and those are institutions. They don't do what they call buy and hope investing. Retail investors, they call it buy and hope instead of buy and hold. They'll ride on and just hope that things come around, and it works and it works and it works in a bull market until it doesn't work anymore, and you're in a bear market, and then you keep going down, and that's the whole cycle repeats just like the last bear market. So as professional money managers, as that chart showed, they have to protect their losses, cut their losses, and so then they have stops hit. And they also, like you and I, as some of us that trade on margin, and a lot of those institutional accounts may be employing leverage, and therefore they have to reduce that leverage, or they can get margin calls like you and I. It's not just individuals. Institutional investors can get margin calls too, and that means they have to then, like it or not, they might see the biggest bounce in the world coming. Doesn't matter. If your broker says you've got a margin call, you've got till 3:50 p.m. or whatever time to either put cash into the account or close out your position. We're going to close it for you. That's how margin calls work. Here's an example. I wanted to show you. I left these lines on here. They should be removed now because they didn't work. But there's divergence that was unconfirmed and didn't play out. This is what I call potential divergence. Why potential? And this you won't find it in the textbooks. It's just something that I've learned in trading over the years to say, well, what makes, in my book, a negative divergence is like right here. You have prices making a higher high. At the same point, you have your momentum indicators making lower highs. In this case, the PPO right here and the RSI. And now these are momentum indicators. So as long as the momentum is up, heading up, they're pointing up. And therefore, that's why at this point it was only potential divergence. Well, what would have made it confirmed? Had we reversed and then put a lower peak. And right here, that's what happened. So when we made a bearish crossover on the PPO, you've effectively put in a lower peak. That gave us negative divergence, and then you did have a decent correction in TLT. So that was negative divergence that did pan out. This was potential divergence that was never even confirmed, because at this point we had it here, and at the point that we crossed above this peak, we no longer had any divergence. And so TLT has just kept running. It has been a beast. That even had that wedge there and everything. It just plowed on right through there. Now, I want to talk about the stock market. There are two things that cause Treasury bonds to rally, primarily two things. One of those is a flight to safety trade. When institutions or regular individuals, retail traders, are worried, but it's usually institutions, the smart money, they flock to treasuries because they're relatively safe and secure. So they take money out of, and they're liquid too, so they can pull money out of stocks, go into treasury bonds, so you get that. Now that all made sense heading into the late December lows. In fact, what was happening back then, I pointed out at the time, we went long treasuries because treasuries were falling with the stock market. The bond market was not responding to the stock market falling, and so we had a trade. It's in here somewhere. We went long. Here it was back here, and we got out there. Then we hit treasuries again here, got out there, but it's just kept going up. Now this is odd because the stock market, remember, is coming right off we're not that far off all-time highs. You look at a weekly chart, and here's the stock market. Here's the whole bull market, and we're barely off the highs. Yet treasury bonds, which again are a flight to safety asset, are soaring. Something's amiss here. You're seeing treasury bonds, and they've been holding up even with the market rallying recently. Now, the other component besides flight to safety is treasury bonds will rally when future inflation, interest rates, and economic growth, which all go hand in hand, when expectations are for being revised downwards. In other words, make it very simple. This is the bond market, as clear as it could possibly tell you. This is the all-time low in the 30-year treasury bonds here, at least going back 40 years or so. that is pricing in a recession, make no mistake about it. And it's also or pricing in a big drop in the stock market. And if you talk to anybody who's done this a long time, that's been worked on Wall Street or investing, they'll tell you, there's an old saying, is that given the two, listen to the bond market, that the bond market's always right. And between the stock market and the bond market, stock market is a lot of retail traders, everybody in the masses, the herds, the general public. And when stocks go up, they want to buy, and when they go up more, they want to buy more. Doesn't matter how overvalued, it's just human nature. And again, I'm generalizing. Whereas typically in the bond market, I mean, how many of you listen to my voice have bought a Treasury bond? Not a bond fund, not a bond mutual fund, but actual Treasury bonds. Not many, probably. And that's because mostly institutions trade in Treasuries. And again, so you're going to see that flight to safety thing. And also the smart money saying that, hey, well, there's a recession coming. But the stock market's ignoring that, also off, all-time highs. Not far off, that is, in hopes that the Fed has somehow, this time around, finally, after all these years, decades of being in existence, finally figured out the magic formula to prevent all future recessions. They've always cut rates, and in almost every instance, once they started a rate cutting cycle, a recession was right around the corner. But as it usually is, the market likes the rate cuts, so it's it's holding up. And again, I'm seeing a big disconnect. Is kind of where I'm going with this. If you're wondering, the point I'm trying to get to is this is not meshing with the stock market being right off new highs. Bad things could happen. Where I was, before calling for a 30% drop, that can happen very fast. And again, there's just red flags. That's all I want to tell you here. And is that I'm watching the bond market, and also talk about divergences and things not playing out. I've highlighted this recently. This is a 60-minute chart of TLT. We had a very clean uptrend line here, very clean. Also very clean and confirmed negative divergence. And I showed you this on ZB as well, the bond 30-year Treasury bond futures. Same chart, same trend line. It broke down recently. Great, sell signal, right? Well, it broke down, but it's rallied up, and it's rallied up with the stock market rising over the last few days. That's odd. I told you I took this one as a hedge to my shorts, expecting that if the market rallied, that we would drop down to at least this level or this one, probably both. But so far, Treasuries have just had a very resilient bid. They seem to be shrugging off this clearly bearish technical posture here. They did correct. Don't get me wrong. They had a correction, but it's just not that much. So it tells me that institutions are still worried about something. They are still buying. Number one, they still think the economy is headed lower. And again, the stock market cannot continue to rise if earnings forecasts continue to roll down, if the economic growth models and forecasts and earnings as well go down. So that's, like I said, this is what I want to do this video. I just don't like this. I'm seeing a lot of concerning signs. This is gold. Let's just look at a daily chart. Here's gold. Now gold has a clearly bearish technical posture right now. I have been, and I remain longer term bullish on gold. And where I'm going with this is right now, This is telling me that gold looks poised for a correction, but if it doesn't, if it somehow manages to burn through this bearish technical posture, these strong negative divergences, I see what appears to be a buying climax. See all these big volume bars? That's what's referred to as a buying climax. Here was a little bit smaller one after this run up, and we topped out and then never went above that point, and we fell from there. You don't look for a buying climax right after a bottom, so you don't look for big volume surges. That's actually healthy coming off the lows. It's after an extended run, that's when you look for things like that. So near term, I told you guys I'd look to position, add gold as an active long trade. Again, I've been harping on it for a long time now as a core holding in a long-term account. But I'm looking at this, and I'm just seeing some mixed signals. We have a very good support around 140 or so, a little bit below there. We'll look at the 60-minute chart. If it breaks that, what this will probably mean is that the stock market, it'll probably mean I'm wrong, that the stock market will probably break out, and it'll probably be more than just a little pop if this chart is going to play out, because I don't see a lot of support. If gold breaks 140, those recent lows around 148 or so, breaks it with conviction, I don't see really much. There's a little gap to be backfilled right here, but there's not a lot of support under it. Probably come down here, maybe all the way back down here. And this scenario would most likely entail the stock market going to very close to or possibly above new highs for that to happen. Otherwise, if my preferred scenario of the market breaking down below those recent trading ranges happen, gold may just burn right on through these divergences like I just showed you TLT did a minute ago. So I wanted to point this out. I can't tell you with the highest conviction which way this is going to go, but I do want to point out, because a lot of you probably have gold and gold mining stocks, and remember, the miners will tend to fall at least twice as much as gold during a correction, and that's just GDX. That's not the 3-time leverage ETFs. They're going to fall 6, 5, 6, 7 times or more. So keep that in mind. So there's my analysis on gold. Just kind of keep it quick. Negative divergences. Here's the last time we had a divergent high, and I pointed it out at the time, and we had a pretty big correction there, pretty decent correction. And I think gold fell about 6, 7%, and the miners fell over twice that GDX during that same period. And then we had a breakout and everything else. So that's what gold's looking like. Long term. Oh, and it just did kiss that 143.87 level on this weekly chart. So like I said, the risk reward right now in gold is not very favorable on the long side. However, I've warned about this before. Don't underestimate just how bought gold can get during when there's a strong bid for it, and it can also burn through divergences like I showed you that TLT did a minute ago. So make it simple. If you're wondering where I'm going with this, if you're a long-term investor, you're keeping a portion of gold in your portfolio as asset allocation, probably fine for the time being, especially if the stock market starts to head that lower and breaks those lows I talked about. Then you'll probably come on up here and gold might just burn through and hit that 151 target. Otherwise, if the market breaks out, well, I want to consider some stops just below those levels I showed you on GLD on that daily chart a minute ago. Okay, finally, let's wrap this up with a quick overview on the semis. Yesterday, I said I had an email from a member of the site had replied to one of the emails that go out when a new post notification is made on the front page, a new front page post. You can reply to those. They will go to a monitor. I don't actively monitor the inbox those go to. So please, if you have a question, it's better to post it on the trading room or on the comments section on the front page, because I wasn't able to answer that question until after the close. That's when I saw it. Now, I'll tell you what my answer was, and it remains the same. The question was, should I stop out where SOXX went below 40.90? I said, look, personally, I don't think so. I give it a little more room. These are suggested stops. The price targets I really narrowed down and put a lot of time into looking where I think the reactions are likely and which one, final target, if it's likely to be hit based on the move of the pattern, the scope of the pattern, and everything else. The stop, I usually pick a point based on a 3-to-1 or better risk-reward ratio calculated to the maximum target, and then I try to align it with some price support or resistance. In this case, you can see some levels there. In hindsight, I didn't know. Had I had any idea we'd be in a trading range, well, of course, that's hindsight. I wouldn't have added the trade yet. And more importantly, this is a function. This is 3-time leverage, and this is a volatile sector. So the reason this was stopped out, in my opinion, and look, it may go lower, but why I might give it more room is this. As I just showed you before, we're in a sideways trading range that I didn't expect to happen as long, and this is a big range. From high to low, it's over 4% on QQQ. When you have that, if you have a trade, let's say you're swing trading anything, whether it's stocks, SOXX, or something else. Let's say you have a trade where you're looking at a 15% profit and a 5% stop allowance on the downside, right? That's your risk-reward ratio. You're going to make 15%, or you were going to risk losing 5. Well, now QQQ, this is just an index. So if the market itself swinging around up and down 4%, remember, most individual stocks will swing more than the overall market because the market's, got other things going up, down, kind of diluting the returns. So what happens in this is you're almost guaranteed at that point to have your stop hit. And Also, very unlikely to have a 15% gain when the market's going nowhere, just gyrating around in this 4 or 5% range. And so, therefore, again, hindsight's 2020. Had I, anticipated that we would be caught in that range and not just do that ABC like I thought, then I wouldn't have added it. So, but at this point, because we haven't taken, this is the main point I'm trying to impress here. QQQ has continued to fail at my max bounce target again and again and again, every time, all day yesterday and all day today, multiple times since we broke down into that range, as has SPY and as has XLK, the tech sector. I did the video yesterday, or I'm sorry, it was a front page post, and I showed you that XLK had a breakout right here. There was a breakout right there. This was their previous breakout to all-time highs, failed right here, made it a bear trap, false breakout, bull trap, and I said that is big resistance. It was former support right here, it was resistance back here, and it's resistance once again. The semis are tech stocks. Semiconductors are a subsector of technology. So one thing I can tell you is if XLK fails here in QQQ and SPY, SOX is going right down with it. And as such, those are things, and again, my bad, my apologies. I did not have an alert set, so I didn't post an update. I should have done that yesterday, and it was that question, so I'm doing it now. And here's the thing: commissions are $1 or even free, up to maybe $7, $8, $10 per broker. So if you got out, if you see the evidence, if we see an impulsive rejection here, or even now we're at the top of the range again, you could add it back with a stop somewhat above. But again, I would also, take into account what the broad market, especially QQQ and XLK, what they are doing as much or more so than what the semis are doing. And then finally, we'll wrap it up here with SOX. Look at a 60-minute chart. This is what it looks like on, remember, SOXX is the non-leveraged semiconductor ETF that trades, it tracks the same index right here, the PhilX SOX Semiconductor Index, the same sector or index that SOXS does. SOXX just lets you, get short exposure, so you can use it if you don't have a margin account. You can do it in an IRA, and that's why I added that as an official trade. But as far as the technical posture of SOX, we have this triangle pattern forming. There's a pretty clean downtrend line. There was resistance here that it popped yesterday, and that's, the stop was strategically set there. At the time, I didn't think it would violate that level, or flip this upside down for SOXX. Remember, this is the non-leveraged positive, or non-inverse. So that was set there, but at this point in time, if you're still in it and you're wondering where to give it room, well, here's a level, and also watch those levels on QQQ and XLK. You want to know where, if you're not in it, or if you are and you want to add to it, well, just like XLK, QQQ, and SPY, you want to see the recent lows get taken out. You might even get a jump on it here on a break of this uptrend line. Remember, QQQ has similar, it's also making lower lows, where SPY made a bunch of roughly equal lows. So this should be the nail in the coffin, I would think, where it would open a door for impulsive selling on the semis if and when the recent lows, give or take right here. We'll move that line down to about, we'll call it 9. You want to be safe, say 192. And again, pops above here, and if QQQ and SPY go much higher, then they're probably going to hit those stop pops. They're probably going to run up and could open the door for new highs. Like I said, there's so many red flags in the market. So at this point in time, any upside break, I don't care to chase on the long side, even if it's try to game that stop pop rate. If what I think happens, we run up, clear all the stops, everything's going to look bullish. You're going to see the market up pretty strong, and then the reversal would probably come pretty swift if it's going to happen, if that stop pop fake out scenario is going to play out in SPY and QQQ and everything else. That's it. That's all I wanted to cover. It's been a long video, but I wanted to get this out there, and again, just kind of put all my thoughts into words, because trading the market's not as simple as just trading SPY and watching those levels. It's a combination of all these things, and then some of those, like I said, a lot of red flags out there right now that make me not comfortable if this market breaks out to the long side. I promise to, as always, to try to be as unbiased as possible, give you the key levels. So if you are bullish and you are looking for much higher highs in the markets, I'm giving you levels that will produce breakouts. Maybe we break out and there is no stop rate, or false breakout. Maybe we keep going. So there's your first, call it buy signal on SOX above there. But again, I wouldn't jump the gun on semis if QQQ and SPY don't break out as well, because if the broad market can't break out, the semis are only going to go so far without it. All right, we will wrap it up here. It's been Randy Finney with Right Side of the Chart. Hope you enjoyed it.